Hi everyone, welcome back to my channel. I'm Laura, and today I'm going to be starting my series about personal finance for students, and the first episode will be about credit. I'll be covering what is credit, why it matters, and also how to build credit as a student. This will be great to help you get started on your personal finance journey as a student, and also to help demystify some of the concepts behind personal finance. So first off, credit. What is it? So according to Experian, which is a company that I'll soon talk about why they matter, they say that credit is the ability to borrow money or access goods or services with the understanding that you'll pay later. In the abstract, credit isn't too hard to understand. It's basically the understanding that once you borrow money, you'll also be able to give it back to the person that you borrowed it from. How we track your credit, at least in the United States, is through a credit score, which is scaled from 300 to 850. Without any credit history before, you'll kind of be sitting at a 0 number, but once you do have an established history of credit, your score will be in the ranges of 300 to 850. If your score is in the 700s, generally that's considered pretty good. 750 is going to be even better for reasons we'll discuss later, and while being in the 800 range is even better, that's basically only useful for bragging rights for the vast majority of us. The three major companies in the US that track your credit history are going to be Experian, which is where I pulled the definition of credit from, TransUnion, and Equifax. You've probably heard some of these companies before, and if not, you now have. These three companies are going to be the one reporting your credit history or score to anyone who may be inquiring about your credibility. So as I mentioned, you start out with 0 credit, and you have to personally work your way up to build your credit into these 700s and 800 scores. It's incredibly hard to get started building credit, obviously, because you start out with no credit. So a lot of these systems that are in place to help build your credit don't actually trust you in the first place to start giving you real money and expect you to pay it back later. So why is credit so important to build? Credit is a system that has been built up to determine if you're able to get a new credit card or afford a loan for your new house or car. Renting an apartment, they look into your credit score and see if you're trustworthy enough to be handling a $1,000 or $2,000 payment every month. So as such, if you aren't able to get access to these lines of credit, such as a loan, then you can't actually buy your next new car, you can't buy your next new house, and in general, you're kind of limited in this world. Unless, that is, you have a huge hoard of cash that you can use to pay off your next car. In that case, just live your best life. The one thing that you don't really need credit for to get a loan from is student loans, because they couldn't care less about saddling you with debt that will haunt you for the rest of your life. In the case that you do have credit though, it's important to get your score higher into the 700s because this will allow you to get the best rates on loans that you take out. So people who lend you money, such as banks, are going to expect you to pay that money back, but as an extra incentive to encourage you to pay that money back as soon as possible, there are interest rates associated with the loan you take out. Interest rates can be anywhere from 0% to 5% commonly, depending on what kind of loan you're taking out. The closer to 0% you are, the better, because that means you're not accumulating interest on the money that you're borrowing. If you have a higher credit score, that means that you're generally more trustworthy of a lender. Essentially, your credit score reflects the fact that you are able to pay back your debts. As such, people are going to be inclined to charge you lower interest rates on your loans because of the fact that they know you're not going to run away from this debt and leave the loaner hanging. Now that you know what credit is and why it's so important, let's talk about building your credit. First, I think it's really important to cover what actually goes into your credit score and how it's calculated. So the first major section is on-time payment. 35% of your credit score is calculated through on-time payment. But the percentage of on-time payments is calculated by the number of on-time payments you have divided by the number of total payments on your credit card. So if you have your credit card for 12 months and you have 12 on-time payments for each of those months, then you're going to have 100% on-time payments. If you miss a month, however, and you have 11 on-time payments for 12 total payments, then you're getting a little bit more dicey. 11 divided by 12 is going to be 92%, which is pretty low for on-time. However, now let's pretend that you have 2 credit cards each for 12 months and say that you've missed 1 payment total across both of these credit cards. That'll mean you have 23 on-time payments and 24 total payments for both of these cards. Just by having more total payments, you've increased the number from 92% to a whopping 96%. 4% makes a lot of difference, especially when it comes to something that affects 35% of your overall credit score. Ideally, you really want to aim for 99 to 100% on-time payments, just so you aren't dinged in this category. Even though in the examples I use credit cards, student loan payments, mortgage payments, car loan payments, those all count towards on-time payments. Make sure that you're tracking any debt that you're carrying still and paying them on time. So the next highest category is going to be credit utilization, which takes up 30% of your credit score. Credit utilization just asks how much of your credit are you using. Credit utilization is measured as the percentage of your total credit and the lower your utilization, the better. So if I have a $1,000 credit limit on my credit card and I spend $100, that'll be reflected as 10% utilization. Utilization on your credit card is measured every 30 days, and this is usually a few days before your credit card payment date. I think it's around 3, but I'm not sure, so don't quote me on that. So how can you decrease utilization, and what is also a good utilization number? Personally, I've heard that 10% is a great rule of thumb to keep your credit utilization below, but nowadays I like to keep my credit utilization around 1%. It shows that I'm still using my credit card at 1%, and it also shows that I'm responsible in paying off my credit card every time. Now you might ask, well, I'm making purchases on my credit card, so I've raked up hundreds of dollars of bills on my credit card. How can I keep a 1% utilization? So there are 2 ways. One is to get a higher credit limit, which is usually not as feasible for people. And 2 is to pay off your credit card as you go, so you're not tracking a high utilization throughout the month. The second strategy is how I've been keeping utilization at 1%, and I check my credit card usually once a week, and I pay it down to 1% utilization whenever possible. The 1 to 10% utilization rule of thumb, though, is just to show that you're still active in using that credit card and utilizing that line of credit that you've established through opening that credit card. So the next section is age of credit, which accounts for 15% of your credit score. Age of credit just asks how long have you had your credit cards, loans, etc. going on for. This one, there's really no easy fix. It just comes down to holding your credit cards for a long time and also have long lists. One thing I do want to note is, for example, if you've opened a credit card when you turned 18 and you got a new credit card when you turned 20, if you close the first credit card, your age of credit history will take a ding because your long standing credit card has now been closed, essentially cutting off 2 years of your age of credit. So be careful of closing credit cards, even though it can be useful depending on what your purpose is. Second to last category is hard inquiries, which takes up 10% of your credits. When an institution pulls your credit report to assess your eligibility for a loan or credit card, this is a hard inquiry and it will show up on your credit record. These hard inquiries stay on your report for around 2 years, but they only affect your credit for 1. The reason why hard inquiries reflect negatively on your credit score is because hard inquiries indicate that you're actively looking for more lines of credit, which can indicate that you're maybe in some sort of financial trouble or issues. Instead, you want to space out the inquiries if you have the luxury to, so you're not constantly opening a new credit card every year, but instead every few years, or refinancing your loans after some period of time. Lastly, types of credit also accounts for 10% of your credit score. Types of credit asks how many different lines of credit do you have. Involve credit cards, and the whole smorgasbord of loans from car to mortgage. Generally, this is showing that you have a diversified history of borrowing and you're also trustworthy in all these different areas. Again, types of credit is one of those categories where you have to be patient and build up your history of credit, not just rush blindly signing up for tons of loans, because obviously that's not how you want to do it. Finally, I want to cover the 2 main ways to build credit as a student or young adult. So the first method is called credit piggyback. You can get put on as an authorized cardholder on your parent or guardian's credit card, and their credit report will reflect on your credit report. This is really the only way to build credit before you turn 18, because you can't sign any loans or open a credit card until you turn 18. And this can be helpful after you turn 18 even, to help build up your credit score if you're looking to build your credit in a short amount of time. I would recommend this if you know that your parent or guardian has good credit and financial habits. Otherwise, this can really end up hurting you, because if whoever puts you on their credit card has a low credit score, and again, that'll also reflect on your credit score, bringing your score down. This also depends on what kind of credit card is being used. Some banks may authorize this kind of credit piggybacking, and some banks may not. So your mileage will vary, and just make sure to check with your bank's institutions to see if they allow this kind of credit piggyback. The second main way is to get a credit card as soon as possible. I know that initially I was pretty scared about getting a credit card because I've heard all these horror stories about credit card debt and general financial irresponsibility. The number one rule that has really stuck with me, though, and how I first started out, was use your credit card like a debit card. As soon as you buy something on your credit card, pay it off immediately. This gets you in the habit of paying off your purchases, and it also guarantees you that you won't be putting off paying your credit card. In turn, this rule means don't buy anything that you can't reasonably afford unless you're in a true emergency or crisis and you need to put that money temporarily on your credit card. The second helpful rule for my credit card was automating payments. Automating payments means I'll never forget to pay a bill on my credit card, and it also means that I'll have 100% on-time payments as long as I have enough money in my bank account to pay off my credit card. This can be a lifesaver if you just have a slip up, so I would urge on the side of setting up automatic payments so you can never forget them. Especially as a student though, and if this is your first credit card, you usually won't get approved for one of the major credit cards unless you look in the right place. My first credit card was a Discover student credit card, and if you're in a similar spot and you're looking for your first card, I would highly recommend the Discover card. It has a reasonable credit limit, and the Discover card has some pretty great benefits for being an intro starter card. I'll have a referral link in the description box below. Feel free to use it. If you do, you get a $50 statement credit, and if you don't, no hard feelings. Generally, I recommend the Discover student credit card just because it's so easy to set up and it's hassle-free. Finally, if you do have student loans because you are a student in college and college is really expensive, they will help you build credit as long as you're paying them off in time. Usually you won't be paying these loans off until after you've already graduated college though, so I'd recommend either being an authorized cardholder on someone else's account or just getting a credit card and building that credit as soon as possible. I know that starting out in the world of personal finance was really difficult for me, and that it can also be a tough spot for a lot of other students. Hopefully this will encourage you to open your first credit card if you haven't already, and generally just manage your credit responsibly. If you have any questions, feel free to leave them in the comments below. Like I mentioned in the introduction, I want to make a series starting out with credit here, then moving on to budgeting, retirement, personal investing, etc. If you have any other topics you'd like to see in this personal finance series, please let me know. If you enjoyed this video, please subscribe and like this video. Otherwise, thank you so much for watching, and I'll see you all next time. Bye!